Hi, and when you finished file 2, you saw how to do the calculation of variance, standard deviation, coefficient of variation, and other measures. This is simply going to be looking at variance, standard deviation, and coefficient of variation, but it's going to begin with by you downloading, or I'm going to be downloading data for Pfizer, showing you how I did it, and later I'm going to ask you to download information from Merck and do the same kind of analysis. So what am I going to do? I go to Yahoo Finance, and I get a window that looks something like this. The advertisement will change, but you have some kind of window like this. And the first thing I want to do is go to the box over on the right with the little magnifying glass. You put in the number in whatever stock you want in here. In this case, I would be typing in Pfizer's name, and then I hit the magnifying glass to search, and what I would get is a file that looks like this. And what this is, over on the left near the top, you can see Pfizer Inc., the name of the company. You also can see the price it was trading at the moment I downloaded this information, $43.65. It was up 69 cents, representing a gain of 1.61%. All right, what we're going to do is go to where number 1 arrow is pointing, historic data. Click on historic data. Then we'll move where number 2 arrow is click where it says frequency. You can change it from daily, weekly to monthly. Click on monthly. And then go over to the left side of the screen. You'll see dates. What you're going to do is click on 3, and I want to shorten the end period, but most of the time you want the end date to stay the same and you're looking for an earlier date period. So I'm only looking for the first half of 2018, so I'm going to have it be 7/1/18. Then I'm going to go over to arrow 4 where it says apply, and I press apply on it. It will blink, and then all of the monthly data will be there for the first 6 months of January. I will say download, so I'll hit 5 and click download. And it will download, and if you look at the bottom of your screen, you'll see that it shows up as an Excel file. And the Excel file will look very much like what you see here. It will have the date, opening price, high price, low price, close price, adjusted price, which means it's adjusted for stock splits or dividends or anything else that's happened during the day. We're going to work with the adjusted price, and then what I've done is calculated the holding period return like I've done before. I'm going to take the 3505 minus the 3576 and divide it by the 3576, and I'll say that the return went down by 1.97%. I repeat that calculation down the Excel sheet, and you'll see a whole list of holding period returns. I take the average of those, and you can either add them up and divide by the number of observations, which will be 1, 2, 3, 4, 5, 6, 7, or you can use the app within Excel. Up on the top right, you'll see a little summation sign. In that little summation sign, you'll see one of the choices is average. You click on average and highlight the holding period yield, and you'd have average. So the average is 1.73% per month for the first 6 months. Next thing we want to do is talk about how much it varies, or calculating the variance. So I have the 7 observations of returns for Pfizer. I subtract the average return from each of them to get the deviation from the average. I square the deviations from the average. I sum them, and they come out to be 1.2%. But there were 7 observations, so n minus 1 would be 6. If I divide the 1.20 by 6, I get 0.199%. That's the variance, 0.199%. If I take the square root of that, the standard deviation is 4.464%. So now I've done exactly what I've done in the previous file 2, but I'm using Pfizer's actual historical data. Next thing I want to do is download information about GSPC. So if you went back to that original screen for Yahoo Finance and you put in GSPC in the search bar, you would get a menu that would come up asking you for historic return, and so you'd repeat basically slides 3 and 4 to get this data. I'm providing you the PowerPoint slides also on Blackboard, so you can actually look at the individual slides. So here I'm calculating the average return for the index, which is 0.4% per month, much smaller than what Pfizer was doing. Now what I'd like to know is a little bit more. I'd like to know what the variance of the S&P index is. So again, I take the actual returns for the EFT, Exchange Traded Fund, for the Standard & Poor's 500. So deducted the average, got the deviations from the average, squared them, added them up, divided by 6. The variance is 0.08%. The square root of that is 2.836%. So the S&P index has a lower return and a lower variance. So let's look at the coefficient of variation. We said before this is a ratio of the standard deviation divided by the expected return. So Pfizer's standard deviation was 4.464. Its return was 1.73. Its coefficient of variation is 2.58, meaning its risk is only about 2.5%, 2.5 times its return. Excuse me for coughing. For the coefficient of variation for the S&P is 2.84 divided by 0.042, which means the risk of the standard of the index, of the S&P index, is about 6.7 times its return. So Pfizer is giving you a higher return with much less risk than that of the average stock in the stock market. With that, we will end. When you pick up with the next file, file 4, we'll be doing the covariance, correlation, and beta for Pfizer. So that ends this